Very much.
The call is officially yours.
Okay, I'd like to welcome everyone to a talk with the finance doctor. Obviously, this is our opportunity to dialogue about all of the important things that are going on in our lives and to talk about this great journey that we're on, this ascension that we are taking ourselves through, this opportunity for abundance that we are all extremely excited to be a part of. This is yet another opportunity for us to remind ourselves just how great an opportunity we have in front of us. This is a reminder for us to continue to walk in excellence, to continue to put ourselves on the other side of wealth and abundance. So what I would like to do, since there are two Craig Bythewoods in there, is I'd like to begin by asking if Corlia has any questions or comments or statements or topics that she would like for us to address.
You know, the only thing that I'm driving, so forgive me if I'm going in and out. Can you hear me okay?
I hear you perfectly. Thank you for saying that.
Okay. I wanted to go over the spread. That is my challenge this week, understanding the spreads.
Okay. So here's a question for you, Corlia. Have you ever been to a currency exchange booth to purchase money to go to another country or do so in another country?
Yes.
Well, when you did so, did you notice that there were two prices? Okay.
No.
Okay, that you didn't.
No.
But there were. So what happens is there are really three columns in the part that displays the prices. And the first column would have each one of the individual currencies that you're dealing with. And then there would be two numbers right next to that. So of course, now that I'm bringing this up to you, you'll notice it and you'll see it, you'll come across it. It's like when someone that you know has a car you've never seen before, and then suddenly you see it everywhere. It was always there, it just wasn't in our awareness. So literally every time you go to the currency booth, there are two prices. Now, one of those prices is called the bid price, and the other price is called the ask price. Now, one of the things that I do from time to time is I teach entrepreneurship classes or do entrepreneurship seminars. And when I do that, I always make the point that the key to being successful in business, in the business world, the key to deciding that your idea is going to work is to recognize that most of the organizations that make the most amount of money in our society are intermediaries. They're in-betweens, they're go-betweens. I've given the example before about grocery stores. Well, we live in a financial world, in an economic world, where the only way in which buyers and sellers of securities can come together is through some intermediary. It is the only way it can be done. So literally, you don't have the option of investing directly into a company's shares without going through the middleman. You don't have an option of dealing with commodities markets or bond markets or foreign exchange markets without going. Think about it. The first thing they make us do when we open up our demo account is choose a broker. That's the intermediary. So I'm saying that to you, Corlia, so that you'll understand this. These individuals have to have an infrastructure for compensation. I'm going off on tangents on purpose, but I will come back home.
Okay.
I had a conversation with someone the other day about music, and they asked the question, why would music be free? I don't understand why people would do that. For example, iHeartRadio, it's free. I've never listened to iHeart, don't have it on my phone or anything, but I said to that person, if iHeartRadio is free, That means they must be charging advertisers to go in and pay so it's free for you. And the person was adamant, no, they don't do that. They don't have any ads. I'm sure you don't have any ads. So very confidently, again, never having seen iHeartRadio, I said, go ahead and open up the app. They opened up the app and boom, there was the ad was there, just like we said with the two prices. They never noticed the ad. My point is this. Everybody that exists in the business world has to have an infrastructure for compensation. And I'm saying all this to say this. When I explain to you what a bid price is and what an ask price is, and I explain to you the spread, it'll have more meaning when you understand that the reason why it's there is because it provides an infrastructure of compensation for the economic market. So here's how it works. Let's suppose that I am a securities dealer. And the way securities dealers work in our financial society is they have a certain number of stocks and they handle those stocks all day. In other words, maybe there are 20 stocks. And all day, all I do is trade these stocks. Now, I'm not trading them on my account. I'm what's called the securities broker, which means when somebody comes to buy a share of one of my 20 stocks, they give the money to me. And then someone comes and they want to sell one of those 20 stocks and I give the money to them. So that is my role as a securities dealer, is I'm literally just like when you go to the casino. I'm dealing out the stocks. So when you buy from me. When you sell, I sell to you. Now, here's how it works. The price that a person buys and the price that I sell it to a person is different. It's different. So here's how it works. All day, when that person is paying the money to me, they're going to pay a certain price. Let's say it's $10. All day, they're going to pay me $10 for the stock. Obviously, my example doesn't work, Corlia, because stocks change value all day. But for this moment in time, we're just going to assume that it's $10. They will give me $10. Now, when it's time for me to take that same stock and to sell it to someone, I'm going to sell it for $10.50. So they'll give me $10 for it. I'll sell it for $10.50. So if you think about it, what I'm doing is every time I shell out $10, but I get $10.50, I'm actually making a 50% profit. I'm making a 50-cent profit. So that is the spread. That is my money market. That is my compensation infrastructure. The difference between what I pay and what I receive. Now I'm getting this feeling that I may have said it backwards. So let me say it again. Every time they sell a stock and I pay for it, it will be $10. $10 is coming out of my pocket. But then every time someone gives me the money for the stock, they're buying it, then it's $10.50. And I did realize I did reverse it. Now here's a good way of keeping it together. It's never about Corlia. Corlia is important to me. She's important to her family. But we live in a capitalistic society. It's never about you. It's always about the company. So it's always about the corporations. It's always about the organizations. So bid, think about it. When you go to an auction and you bid, you go to Craigslist and you bid. When you go to eBay and you bid, what are you doing? You're buying. But it's not from Corlia's perspective. It's from my perspective. It's not from the individual investor's perspective. It's from the organizational intermediary's perspective. So every time I buy a stock or buy a currency pair or buy anything in an economic market, I pay a certain price. Then every time I sell it, I'm going to get a higher price. So the ask price is always higher than the bid price. Now, I use the example of 10.50 and 10. And then I said, well, that's not really a good example, Corlia, because prices change. But it's like an escalator. They shift up and down. So maybe it goes up to 11, and this will be 11.50, and maybe this will go down to 9.50, and this one will be 9. So and it's not always a 50-cent difference. I'm just using that as a basic example. So the difference between the bid price and the ask price is the spread.
Okay.
Now, what do I do conceptually with the spread? Well, the tighter a spread, then the less risky a particular market is, the more stable it is. The higher the spread, the more instability it is, which also gives me more opportunities for profit. There's a particular saying in finance: high risk, high return, low risk, low return. So the possibility of the bid-ask spread being bigger is going to allow more opportunities to trade at a higher price, more opportunities for profit. Tight spreads, conservative. Wide spreads, risky. Bid versus ask. And it really, it does affect you, and it is there for that reason, to provide an infrastructure for the intermediaries to be compensated. That's what it's about. Mm-hmm. But understanding the spread does help you, because you can see the distinction between going into this market and investing versus going into this market. I'm talking about currency pairs here. The two separate currency pairs will have two drastically different spreads, which is an indicator of the risk differences between them. Did I answer your question, Corlia?
You did. I'm putting it together. I'm sure I will go back and listen to what you just spoke to me over again. Mm-hmm. I parked so that I could hear this part of it. But
so I apologize for interrupting. So I do this for a living. I teach, not finance and economics for a living. I teach for a living. And one of the things I've noticed is that we students always do what you just did. We have an opportunity right now in this moment to get it. And we say, oh, I'll go back and I'll do it later. You don't have to do it later, because you're right here on a talk with the finance doctor. So the follow-up questions that you ask right now will probably take about 15 seconds. But if you go and look at it again, it's going to take 15 minutes. So we should do it in a more efficient way. So now that we're here and I've broken it down, something new to you that you've never heard before, ask the follow-up questions so you can get it in this moment and use those 15 minutes for something else productive.
I guess I made that statement because I was driving, and I'm diligently trying to give my undivided attention to what you're saying.
Yes.
But I'm driving.
Okay.
But the only it's clear what you're saying. I guess in going in with my pair, understanding the spread and the spread amount, I think that's where I am.
Okay. So now, you know, when we do our trainings, we talk about buy positions versus sell positions. So you understand just the fact that there's a buy and a sell means that at any one point, the analogy works, where it's obviously simpler when I'm talking about just buying a stock and selling a stock, because it's one security and it's one flow of money. You buy it, the money comes out of your pocket. You sell it, the money goes into your pocket. But from the perspective of the intermediary, every time you buy, the money's coming out of their pocket. Every time you sell, then the money's going into their pocket. So in reality, it becomes a little bit more complex. We talk about two currencies moving, but the fact that you have buy and sell means you can understand that you can be on both sides of the transaction. So the intermediary that's behind the scenes that you don't see, that you don't deal with, they are the ones who are spending their days buying stocks when people sell. Let me change that. Buying securities when people sell and selling securities when people buy. So oftentimes when I provide this example or this particular subject, people will get twisted which one it is. Is it this one or is it that one? And all you have to remember is it's never about you. It's never about you. So bid is from their perspective. Ask is from their perspective. How much are you going to ask for that? Sell. How much are you going to bid on that? Buy. Does that make sense?
It does, yes.
Excellent.
Yes,
Thank you for that question. Very good question.
Thank
Can
you
So
so much for that.
say it again, Corleone.
Thank
no,
you
that
so
was
much for that.
You're welcome.
this
Tasha,
is
were you
kind
about?
of
Yeah.
yeah, I wanted to add something on top of that. So, and thank you so much for that question, Collier, because that's brought a lot of clarity to even me understanding it. So that's a real good topic for tonight. Um, so is that like when we place a trade and we put our trade in, that's why when we put the trade in, when it hits when it hit the first number, but the whole spread has to clear it before it excuse me, I have a cold, but the whole spread has to clear before the close.
You're absolutely right. I just want to take that point you made and give a much more simpler example. So I've decided that I'm going to sell, ooh, let's go old school. I'm going to sell frozen cups. So I'm going to sell my frozen cups for 25 cents. Okay. And I know that I spent 5 cents for each one of them, for the cup, for when I divided the number of the price I paid for the Kool-Aid, and then divided it into the number of cups. It cost me about 5 cents per cup. So when I get a quarter, I could say, oh, look, I made 25 cents, but I really didn't. I really only made 20 cents. Why? Because I put 5 into the situation. So if I say my goal was I want to make 25 cents per cup, then I'm going to have to wait until I sell that second one so it'll clear that 30 range. Once it clears 30 cents, now, okay, now I've really made 25 cents because I have to incorporate how much I paid for the frozen cup. So that clearing you're talking about is the same exact situation. I've got to go beyond where the actual profit amount is based on the spread. And again, the wider the spread, the more I have to have it fluctuate in order for me to make that money. And the tighter the spread, then the easier it'll be for it to go over that point. So what you said was a perfect example of it, Tasha. I just wanted to have the complex foreign exchange and the simple ghetto frozen cup so that we can put those together.
Okay.
Yeah, I know y'all remember frozen.
Yes.
Any other questions from anyone? We really should walk in this momentum we're in right now of asking questions about concepts that we may need a little bit of assistance with. My 9th grader has a biology test tomorrow. And so she was asked to come and play in a scrimmage tonight with high schoolers. She was a little intimidated, tried to get around it. I made her go because I'm just that kind of mean dad. So her thing was my biology test, my biology test. So while we were driving to the gym and from the gym, I began to give her a little bit of counsel on how she could study. And so one of the things that happened was she gave me a definition. So I said, what's the definition of blah, blah, blah? And in the definition, she had the word lipid. And I said, what's a lipid? So I explained to her that if you truly want to learn to the greatest degree of learnidity, you never want to define something with a word in it that you don't know the meaning to. And oftentimes we're so caught up in the concept, the situation, the trade, that we may not think that we're not comfortable with every single word. That's why this forum is so valuable. So if there's something that you're doing right now and you understand it and you're asking about it, but there's one little word like lipid in it that you're not sure of, this is the forum to ask. Explain to me what this means, because the more terminology you understand, the more comfortable you are with being able to respond to things, when there's an adjustment and there's a change, and when you start getting deeper and deeper into the trades, the more understanding you have, the better. So I'm asking you to really think right now. We have a momentum of question asking right now. So I want you to think right now of things that you, in your mind, you think you know, but there may be a couple of little terms or words within what you know that could require some clarity. So please, questions, comments, testimonies.
Dr. Bythewood,
Yes, sir.
Can you help the audience understand, and I'm sure they've heard this word on multiple occasions, what it means to have a bullish market and a bearish market?
Okay. So, first of all, understand that the term bull represents something positive. It represents charging ahead. We're going up. It's an incline. That's what bullish means. Bearish, on the other hand, think about the fact that bears hibernate in the winter. They go down. So bearish simply means that it's going down. I remember when we were young and we would run track, and if somebody was going around the track and they started to slow down at the end, they would say that bear got on them. So the bear is indicative of, in this scenario, of going down. So bullish, I'm going up. Bearish, I'm going down. So what is happening here is that when you're at a particular place in an economic market, what is an economic market? A market is a collection of buyers and sellers. Anything that involves any money, affecting money, indirect money, interest rates, stocks, bonds, money markets, whatever you're looking at, the economic market has a particular position. And you know that all economic markets move in cycles. It goes up and then it goes down. So if you're at the bottom of a cycle and your feeling or your indicators say to you that it's about to go up, it's bullish. So think of some of the terms you've heard. Hey, I'm bullish on this stock. I think it's going to go up. Hey, we're about to hit a bear market. That means we're at a peak. We're at a position where it's about to go down. So bullish, we think it's going up. Bearish, we think it's going down. Now, yes, bearish and bullish is normally associated with overall markets from a macro perspective, but you can also use those terms to describe micro situations or individual unit situations. For example, I am bearish on this stock, so I should short it. I am bullish on this stock. You know, we're bearish on this currency pair, so we need to take a sell position. You know, we're bullish on this currency pair, so we need to take a buy position. Does that answer your question, Mr. Rogers?
Yes, sir.
Excellent.
Since we are operating in this energy, you've always described why the currency market is conducive to participate in via the stock market, not being opposed to the stock market, but from a liquidity standpoint, having more opportunities. And one scenario I was sharing with someone this evening as I was kind of helping them understand the concept of why the foreign exchange market is so important. I think Google closed at $1,138 a share. So, and from a conceptual standpoint, having the ability to afford one share of stock in Google versus having, in that same scenario, $1,100 to maximize the foreign exchange market, having access to having one share, but having the ability to multiply that same expenditure or investment into the foreign exchange market. Do you believe or anticipate that there's a greater return long term because of more disposable cash and having it able to multiply a lot faster versus looking for that one share to increase to become profitable in order to generate the same amount of revenue?
So let me start my answer to that great question by talking about a concept where companies will take their shares and they will split them, a stock split. Now, whether you've heard of a stock split or not, You will understand it in about 2 minutes. What happens is, at any point, the company that has issued the shares of stock has the right and ability to be able to take each individual share and split them into whatever divisor they want. So if I have one share and I do a 2-for-1 split, now that one share is worth 2 shares. So keeping it simple, it's a $2 share. If I split it 2-for-1, now they're 2 shares worth $1 each. If I take that same $2 share and do a $4-for-1 split, now each of those 4 shares is worth 50 cents. I'm saying this because I want you to understand that the pattern that most companies deal with is this. I want my shares to go up. I want my stock price to get high. But I also want people to be able to buy my shares, and I also want companies to be able to help me raise money. That's the purpose of me having shares. So if I've got an $1,100 share, that's good, because that means my stock started here and then it went up. That's good. But the next time I want to raise funds, the next time I want to do a stock issue, the next time I want to do a public offering, no one is going to pay $1,100 per share. So guess what Google's going to do? They're going to split it. It's the same amount of money, but the number of shares has now increased, doing 2 things. Number one, allowing them to maintain control. Because the more shares there are, the higher the chance that anybody can get 51% of my company and run my show. Number 2, when it's time for me to issue shares, then I now will be able to get more people to invest, more institutions to invest in my public offering, thus increasing the chance of me raising money. I have to say this again, Gerald, your question is excellent, but you made it about you. You made it about you, the investor, and it's never about you, the investor. It's always about the organization, capitalism. So what Google or any other company that has a high stock price will do is the moment that stock price gets too high, they'll split it. Why? So they can ride the wave back up. Split, ride the wave back up. Split, ride the wave back up. So that $1,100 share is not designed to grow in value. It's designed to give them maximum value, then it's split so it can be affordable again. So if you've got a good company, a great company like Google, and their stock price is high, not only is your statement about it being more profitable for you to use it in the foreign exchange market right on, but it also would not make sense to purchase a stock based on it being high. If anything, you don't want to purchase it because you can wait. My wife loves shoes from Macy's. And I asked her one day, why do you like Macy's shoes so much? High quality. If Macy's has a 75% off sale tomorrow, did the quality go down? No, just the price. So that's the deal. If you are paying a large amount of money for one stock because it's a quality company, then you're looking at it from your perspective and not their perspective. When you look at it from the company's perspective, as soon as it gets what they consider too high, or as soon as they want to raise more capital, they're going to split it. It's going to go right back down, and that's when you buy. Does that make sense, Gerald D. Rogers? So while I'm waiting on Gerald Rogers to tell me that was an outstanding answer, does anybody else have any questions about anything that would like to add?
I have a question on what you just said.
Yes.
So if I have stock if I buy stock and I'm thinking it's supposed to grow in value, and it goes up because, with my background, I learned the book knowledge on this.
Mm-hmm.
And if it's supposed to grow in value and I'm looking for it, I necessarily don't want my stock to split like that, right?
No. You're cool with that because now you have 4 stocks. Now you got 8. So
Okay.
and because it's split, you just got to ride the wave up again. My point
Yeah, that's
wasn't
what I mean. But and that's what I'm saying. And I think that's what I think the point that he was making. I think in the question, because if I'm comparing this to not saying stocks are bad, because that's good for long term, but you gotta wait, like you say, you gotta wait and ride it out. So if I buy some stocks and I got to sit and invest and I have to wait and continue to ride it out. And I know people buy stocks and they profit and they do well. So it's not, not a bad thing. But if I'm looking for, like the concept and what we operate under as far as being our own bank, I'm looking for some profit today, or I'm looking for some profit sooner than that, and not having to sit and wait and ride it out, because stocks go up and down and up and down. And I think, I kind of think that might be, where we can make money now or make money today, as opposed to having to sit and wait on the market. And, I think that's the direction of, I don't know what happened, Mr. Rogers, or what did
No,
he
I'm
put?
back. No,
Oh,
I guess let me clarify my question from a point of emphasis. Uh, I when I'm looking at, having the ability to have disposable capital of, in this scenario, $1,200, and if any movement takes place, because the likelihood of it splitting in a day's time, right? That the company controls all of those outcomes, and
correct. Correct.
I'm just simply suggesting that if I have $1,200 liquid capital because of this education that we now have, I'm simply saying, from an expedient and a multiplication standpoint, and being able to multiply money quicker, and because of the movement and the larger pool, uh, is it more effective to learn this skill and multiply those $1,200 quicker than it would gain value because I only have one share?
See,
And,
here's the deal.
mm-hmm.
You had me at, is it? I just was so interested in making the second point that I probably didn't spend enough emphasis on the first point, which was you are 100% correct. So I was adding on to your correctness by saying, plus, if you buy this $1,100 stock, in a minute, it's going to be worth half of that. So I am 100% with you, because you remember the first time and subsequent times when I talk about why this foreign exchange market is so excellent, one of the things I say is, in the stock market, you have to predict who's going to do well and who's not going to do well. With currency, with foreign exchange, you don't have to do that. We don't care about who's doing well and who's not doing well. All we care about is movement. So absolutely, I have infinite more opportunities to multiply that $1,200 in the foreign exchange market than I do in any stock market, but especially buying one share of Google.
And I guess, since we're in this forum, and I think really, from an individual standpoint and understanding the value of this information in this setting. So for those individuals who don't have the high liquidity to take advantage, i.e. a Google or something like that. So from a conceptual standpoint, it helped me with this understanding, Dr. Bythewood. So the next thing that was recommended to all of us was the opportunity to participate in mutual funds, which basically gives an individual an opportunity to have access to a pool of stock, but have fractional ownership. So simply meaning, if at their place of employment, that company is offering a 401k plan, so that individual says, I want $200 a week coming out of my check that goes toward my 401k plan. Is it feasible to just take that same understanding, and instead of us lending our money out to that company? Is it feasible to understand and adopt this educational platform to, in most cases, do the exact same thing what those 401k plans are doing with our money?
So here's the deal about why 401k is another level. Why is it called a 401k? It's called a 401k because Chapter 401, letter K in the IRS tax code is where they discuss it. And to me, anything that's named after its IRS tax code, there must be some tax implication I need to understand. So what happens is money that goes into your 401k goes in pre-tax, meaning they take the money out of your check before they take any deductions out of your check. So out of your pay. So what that means is, assuming our tax rate is 28%, that means every time you put $1 into a 401k, you're actually putting in $1.28. You're putting in the dollar, but you're not having to pay the 28 cents on the dollar, so you're putting in $1.28. If you instead take your own money and invest it in any market, whether it's your own mutual fund or whether it's foreign exchange, you have to pay the 28 cents first. So you really only have 72. So to me, anytime you start comparing 128s to 72s, the 128s are always going to win. So what we want to do, if we have access to 401ks, because at this point, let's be real, fewer and fewer companies are offering them. Companies are even paying people 39 hours or calling them part-time or calling them independent contractors to not have to do it. But if you have access to a 401k, that pre-tax is huge. So I'll take the 128 plus I'll take my 72s and put them in my foreign exchange, which again, I'm just adding frosting to my cake. But the 401k, because of the tax implication, is huge and should be taken advantage of any opportunity you have.
Dr. Bythewood?
Yes.
Okay, we were talking about 401ks, and that was a question that I was going to eventually get around to asking, but since Gerald has brought it up. So are you saying that if you have access to a 401k, that's good, you should stick with it?
It's not good, it's excellent.
It's excellent.
Again, because of the pre-tax. There's nowhere else where you can make 28% on your dollar other than the foreign exchange market doing nothing. You have to do something in the foreign exchange market.
Okay.
Just by putting $1 in, you just earn 28%.
Okay, gotcha.
Pre-tax. And see, here's the deal. There's that why again. The government knew that Social Security was going to fail us. It was going to fall short. So they invented the 401k so that people could catch up and have large amounts of money when they retired to make up for Social Security. The thing is, they just didn't explain it, nor did they make it mandatory. So if I can just give you one quick point. Prior to us inventing 401ks, we had old school pension plans. So you work for a company, they will calculate what you get, they pay you a pension. Guess what percent of people who had access to a pension plan got it pre-401k? 100%. Every person that worked got a pension. Now it's optional. Now you can do it. Now you can pull your money out before. You can borrow against it. So now guess what percent of people who have access to a 401k invest the maximum? 22%.
Okay.
So we went from 100% to 22% because we just don't understand how it works. So I'm here every Tuesday and Thursday. So there's not going to be a bigger believer in the foreign exchange market than I am. But we have to be real about the fact that a 401k gives you an opportunity that is unmatched simply because of the pre-tax component. If you think about it, you could just take the money that you're saving in taxes by investing in your 401k and use that to invest in IML. Invest that to invest in your 401k into your currency exchanges, because technically every dollar that you put in, you just save 28 cents. So if you take the total amount of money that you put into your 401k this month, you technically have that amount available to invest in foreign exchange. So it is the best of both worlds. This is not a mutually exclusive. This is not an either or. This is a thank God I have both.
Gotcha. Okay. That makes sense. Thank you for that.
You're very welcome. Okay, it is 39 minutes after the hour, and I want to ensure that we end our days in a timely fashion so that we can start fresh on our Fridays. So I will ask one more time, does anybody else have any questions or comments about this topic? What I'd like for you all to do is to really think about some of the things that we've discussed tonight. I just feel as though we started stirring the pot, and some thoughts and some awarenesses are going to start flooding into your subconscious. And I'd like for you to bring those comments on Tuesday, so we can continue this conversation in addition to us praising how excellent this foreign exchange market is for us to be investing in. So thank you very much for your attention. And I will turn this call back over to our illustrious host.
Thank you so much, Dr. Bythewood. This call was excellent. This is exactly what it's designed to be and what it's designed to do. Tonight's talk with the finance doctor. This call was excellent. It was wonderful. And just as we said on Tuesday, we were going to come with our questions, come with our comments, because this is exactly what it is. It's a talk with the finance doctor. And I think tonight we are all leaving with a little bit more clarity. You know, we're leaving with more knowledge because we are asking our questions now. We're feeling a lot more comfortable being able to ask, which is going to enhance our trading. And that's what we're here for. It's enhancing our knowledge, you know, and which is going to enhance our trading. It's going to make the charts a lot more clear. It's bringing clarity to everything that we're doing. And so we appreciate that. And we say thank you for you taking the time to give this to us this evening.
You're very welcome.
To everybody on this call, Sunday night, we have our leadership call, 9 p.m.
Excuse me. Oh. I actually needed to make an announcement. Actually, we're going to push it up to 8 p.m. Eastern. And 8 p.m. Eastern. My apologies. Moving forward, starting September the 9th.
Well, you heard it straight from the leadership, the gentleman who does the training himself. So on Sunday night, our leadership training call will be at 8 p.m. It will be at 8 p.m. Now, what we're here to do is we're here to enhance you all the way around. That is to help you with your trading, to help you with your leadership residually, to help you in both sides of the spectrum. So with that, everyone, I will see you Sunday night at 8 p.m. Eastern. That is 8 p.m. Eastern Standard Time. At the same link. With that being said, this will officially conclude this call, and you all have a wonderful and blessed evening. This call is officially over.